There's coffee there. And we are live on Oz Property Investment. We bring the big names and we have the big fun. Apparently, we've got a better co-host. How you going, Steve? Before we get,
I'm good, man. I've been living off no sleep because we just got to the UK and Bubs did not sleep on the flight at all.
Oh no, that's not fun. That's never fun. Well, that's okay. Well, you got your coffee there. We'll buy you coffee along the way. You can go during the break. How are you going?
Jeremy's got a little one as well. He's probably got the same story.
Yeah, we do. Two little children, so they're probably running amok at home while I get some extra work in during the OzProp podcast. So really looking forward to today, and it's going to be exciting. There's going to be some opinions that we're going to share with each other, and hopefully a bit of debate. And I'm going to present some real data, some real numbers that clients are currently going through, and share some of my own numbers from my portfolio. And I'm looking forward to being criticised and critiqued by both yourself, Jeff, and Steve.
Yeah, definitely. I already saw in the pre-chat, I saw some information. I thought that's interesting why you've decided to go with that strategy, because it's to give people a bit of context. Maybe it's a bit around the granny flat sort of thing. And so stay tuned for our critique of that. Maybe I'm being controversial deliberately, but drop us a comment, drop us a like, all that good stuff. So I'm excited for this session. It's going to be great. We're going to talk to inflation, and there's even some divided opinions on what that means for your property investing. We're talking about this 5 minutes before, and then we'll get into the real main course. It's how to outperform the market, and sort of looking at the real numbers, because not a lot of people do this. They all sort of talk about, oh yeah, just made 400% cash on cash return, but what does that actually mean? Like, let's look at the raw, and it doesn't always look pretty, and sometimes look better than what we think. And then we'll get into, we love talking structures and trusts. So it's going to be a huge session. So before we get into it, I want to know, I will introduce you. So we were talking today, you've been in accounting since 2009, Jeremy, for those who haven't seen, and you've been doing for a small and medium business is your passion. It's your bread and butter. And I heard on your podcast recently what we should have learned at school, something like that, what they should have been taught at school. Something I've butchered that. I do listen to it, but you've got a $17 million property portfolio. So that's amazing what you've done throughout your time. Hope you're okay. Well, it's a public number. So, but no, you've got a passion for your teams out of it this year. The Rabbitohs have officially been not booted out of the comp, but the Bulldogs are going to be grand finalists in 2025, 2026. So we're building nicely, but no. For those who don't know Steve Polizzi, he's done over 2,000 properties in commercial and resi, but I think he's got the best bid in property, as voted by everyone in Oz Property. If you disagree, then drop a comment now. But I don't think anybody's disagree with that. But no, it's exciting. Thanks for jumping on, Steve. So
no, I'm looking forward to this. The thing I like about Jeremy is he has the real numbers from everyone. Like, he's an accountant. He sees what actually they make at the end of the year, what they don't make, and there's no bullshit. There's no social media fluff of I made 500K. He actually knows. And even I'm surprised sometimes. He does my tax personally. He's like, this property was 40 grand a year positive. I'm like, was it?
Yeah, there you go. How good is that? Was that depreciation and all that sort of, like, yeah, it's good to have those numbers and all that sort of insight. So before we get into the real meat, the crux of the show, because we've asked you what got you started in property and your first property purchase, Jeremy, but I want to know, and this, I think you already shared it with me, but maybe you could share a different example. What are you looking to do next in your property investing portfolio? Steve's left already. He's done.
He's running away. There you go. So my strategy now is a bit more focused around the profit and loss of the properties as opposed to the capital growth. I'm very happy. I'm more than happy and very humbled to be in the position that I'm in with so many years of hard work and consistent investing since 2009. So for me, that is looking after itself. If I just continue to hold the portfolio and go through the numerous cycles all the way through my retirement, if it doubles every 12 years, it's going to be a number that I can't even fathom. But it's really honing now the P&L of the portfolio and making sure that I'm focusing on not just what the balance sheet looks like, but making sure that the income's there. Because in the end, you ask any investor that's out there, their main primary focus or their main primary comment is, I'm building a portfolio to live off the income. But oh, so how little that comment turns into fruition. So many clients are building a portfolio not to live off the income. They're building a portfolio and working their backsides to maintain it, because they never go through that pivot or that rebalance within their portfolio to start making cash. And in the end, if you're going to be, living off this golden goose, what you've worked so hard for, you need to make sure that you're managing both sides of the financial accounts, which is not just a healthy balance sheet and really good capital value versus, your loans, which is called your net equity position, but you've also got to focus on the P&L. Because we all know in business, and we're lucky enough, all three of us have been in business for a number of years, if you can't convert a valuation into profit for shareholders to share in the dividends, they're going to exit your business pretty quickly. So you've got to have a very healthy accounts, and they need to balance at one stage or another, because if you don't, you're going to run into some trouble. So for me, my stage now in my property investment journey, my portfolio is really refining my P&L, making sure that I'm really strengthening the actual profit that I'm generating from the property, and not just relying and hoping for cycles and capital growth. And really looking at value adding where I possibly can. So going back to a lot of the initial properties I purchased and making sure that I'm executing on the business strategy and the business plan that I initially had when I bought the property.
Jeremy, would you see a difference in the way you described, like worrying about the P&L versus worrying about the cash flow? Is there anything different in your mind when you hear those two terms?
They're very much the same. Cash flow is the difference, obviously, between what comes in and what goes out. And most people will, comment and say that's in contrast with how P&L works, income and expenses. So very much the same. I believe there's a consistency between both words, but the interaction of those words and the outcome of what it achieves is exactly the same. So for me, Steve, when I talk about the P&L, I'm talking about cash flow. I want to make sure there's a strong cash flow that's there. And for people that are listening as well, you want to be able to hold a portfolio during these times when interest rates are a little bit higher. You've got to make sure you've got the quality assets that are producing. And at the moment, it's 50-50. I'm seeing property investors not being really too phased by it. They've still got very strong jobs and strong incomes. But on the other side, I am seeing the other 50% really starting to scrape the bottom of the barrel. And the healthy buffers that they built up, Steve and Jeff, during low interest rate environment is starting to really dwindle. So it's all about the budgeting and the type of asset that you're holding as well.
Yeah, and that does dovetails quite nicely into something you said a couple of weeks ago about being arrogant, Polizzi. An arrogant comment that you said that you're focusing more on converting it into cash flow. So there's an alignment there already between what you're both sort of doing. And I must be fully transparent. I'm probably more focused on my capital growth side of things. So I'm still building that base myself personally, but not at the disadvantage of cash flow. But to me, you guys you got your 17 million. I think Polizzi, you're probably in the at least deck of millions. You bought that
At least 100, Jeff. Surely that's what social media is.
100 in the 100,000s. I mean, no, but so for me, there is that trend. And before we get into the inflation, what I wanted to know, how do you typically see people make that transition in their journey? They start off being capital growth focused, building out that sort of equity base, and then getting to a stage where they can sort of pull back and start to focus more on the cash flow. Is that the way it typically happens in people's property investing, or does it depend on the person?
I might go first, Steve, on this one. I probably can say I don't see a lot of people, Jeff, actually transition at the right time or even transition well from capital growth to profit and loss positions. In fact, I see things break first before they actually start to sell down. So rather than strategically maybe selling down or strategically starting to add value to improve the P&L and cash flow position of the portfolio, they're waiting for something to break. Or it could be a very big land tax bill for 50, 60 grand that they just don't have the cash to do it. It could be a new roof on 2 properties that need to be done. It's $150,000. They don't have the access to capital. So typically I see events like that occur before that light bulb moment hits their brain, and then they start to really think about, well, I do need cash because I haven't got a business or I haven't got full-time employment where the gift just keeps giving of income every week, fortnight or month. So I probably don't see many investors, in fact, very few, make the transition at the right time and effectively do it well. Steve, you've got? I know you've managed lots of different clients. What are you seeing?
Yeah, so it was actually your advice that you said to me was you need to pivot as you personally kind of grow with your portfolio as well, because me and Jeremy both operate businesses. So we're a different risk profile. We probably make a different income to certain people as well. And even Jeremy said, look, now it's time to probably look at offloading some of the little townhouses I own, the little houses, and transition that into profit-making properties. So we're actually, but I want to ask Jeremy actually a question. With someone like you who runs a successful business, do you forecast like the next 5 years your own investing, or is it normally like a shorter term plan of like, okay, business has made this year, I've got this equity, I've got this funds, I'm going to buy? Is it just a keep accumulating phase of that P&L, or is it like some long-term strategy or a number you're trying to hit?
So in the technical terms of the accounting realm, they say a business plan typically is anywhere between 2 to 5 years, and a vision is 5 years or more. So a vision is what you work towards, but a business plan is what you try to execute. So for me, I'm always looking in a 2 and 5 year block of the low-hanging fruit, the things that I can do within 2 years, and then trying to execute the things that I can do in 5 years. But I always have my vision, which is what I'm always working towards. It's that old Matthew McConaughey speech that he came back with one day, and he said, you've got to have that person you look up to, and who he looks up to is himself. 10 years from now, 15 years from now. So 2 to 5 years, Steve, is my business plan. That's the things I try to execute within 2 and work within 5. And then the vision's always going to be there. That's my 10-year plus dream.
That's exciting. And
I was going to say, Jeremy, with your height, wouldn't you look up to everyone?
Yes, especially you, mate. When I'm 5'5" and you're about 6'3", it's
shots fired already. Jeez.
My neck gets sore pretty quickly.
So apparently, I'm supposed to be the commentator tonight. I'm supposed to pull these guys back in lockstep. So how fun is that? But no, I was going to say it's an interesting kind of. When I first started investing, and you're in your old office 10 years ago, close over 10 years ago now. We sort of remember that you would tell me like focus like this property, because I was impatient, sort of bright-eyed, bushy. I wanted to see the perf-like gains in the property that I had. And you said to me, look, it will go well. Just got to hold it. It's a good, and eventually it has sort of seen those sort of gains. So it's just interesting to sort of see that people underestimate what they can do in that sort of, or they overestimate what can happen in 1 to 3 years, but in that kind of 10-year period, the Matthew McConaughey kind of thing. So it's as best I can these days. Hopefully everybody can as well, focus more on not the sort of short-term noise, the media cycle that sort of happens that we see day in, day out. On that point, and we've got contrasting views on this as well. I think Steve and I are a bit more aligned, whereas Jeremy will probably give a more straight bad answer. What do you guys think about the CPI print today and where interest rates and what the economy? What are we sort of looking like for the next sort of 6 to 12 months? And Steve first, what do you reckon?
I'll give my answer first because mine's a dumb answer. I personally don't care because I can't control it. So anything I can't control. And I'm always buying an investment with a 5-year plus plan. So that's going to change over 5 years. If I can't, it's not like interest rates where you need to have adequate buffers for it. So if it goes up, great for my commercial properties. If I've got CPI aligned with that. If it goes down, I don't make as much, but it's not going to change my decisions now. I'm not going to sit there for 2 years being like, oh, I'll wait for inflation to change. So for me, I'm not an economist. I don't understand the economy. Jeremy is into that. He reads Economy Weekly or whatever the magazines are called. I just buy with the mindset of, is this property going to be in more demand in 10 years' time? Can I hold the costs? What's the worst case scenario? And then go in guns blazing from there. But Jeremy will say something a bit more eloquently than me, I think.
Look, from my perspective, inflation means a very hot market, a very hot economy. People are making a lot of money. There's significant costs involved in potentially building new properties, and that's why we're seeing building approvals come down in some aspects. And yes, interest rates do follow to help cool it. But I'm not actually really concerned with interest rates rising in moderation. I'm actually more concerned with interest rates significantly reducing, especially overnight, because for me, that means we really do have a broken economy and there might be a significant loss of jobs if interest rates do significantly come down quite quickly. And that's going to actually hurt property prices substantially more, because then you won't have people with the ability to afford to buy properties at a higher price, or even with the ability to rent your particular property because they don't have the income, because they don't have a job. So at the moment, I still think interest rates, even though people might say I'm crazy when I say this, interest rates are cheap. And I can say this because when I first started investing back in 2000 and probably 8 or 9 now, when I think about it, my first interest rate was nearly 9%. And I remember high-fiving and cheering when it came down to 7 as the interest rate started to come down post-GFC. So historically, I know interest rates, the historical numbers started to drag back because we've had a decade of low rates, but we are still in a very cheap interest rate environment. Compared to where things have been over the last, say, 30 to 40 years. So at the moment, I don't think what we've recently seen on the print's going to change too much of the RBA's decision, but I more look at the job numbers. I'm looking at new jobs being created and I'm looking at job losses. To me, that's got a bigger factor on the residential and commercial property market, because if people don't have jobs and people can't work and they don't get paid, money doesn't cycle through the economy, and that will trickle across everything as opposed to being concentrated just to one issue.
Would you, Jeremy, ever hold off buying if you saw some numbers that you weren't attracted? Because we've had this chat many times about whether hold cash versus put in assets. Is there any signs where you'd say, oh, I actually might sit out of the market for a year or two, or would you just pivot and change the opportunities that you're looking at?
Yeah, I think you always got to have the mindset of opportunity. There's always going to be an opportunity in any different market. But in saying that, sometimes doing nothing can be the best decision as well. Sometimes sitting on cash and holding back and waiting for things to happen is not a bad decision. I sometimes will look at areas go up 10 or 15% before I feel comfortable enough to buy into it, because I never try to pick the bottom and I never try to pick the top. I've definitely sold with money on the table, but I've always had a different opportunity to move it into. So I do look at certain things. For me, though, job data is probably the most important. How tight the job economy is or how loose the job economy is. Because in the end, if people don't have jobs, they're not confident, they don't spend, they're not earning money. And as I said, that's a massive ripple effect, more so than, say, interest rates moving. And let's face it, 0.25% interest rate increases. I know it's something and it may hurt some people out there, but it really is a very blunt blade. I'm more worried about interest rates increasing like they did in 2007, just before the Howard-Rudd election, 1%. That was when the RBA had spines on their back and they would move interest rates at 1% and 1.5%. None of this 0.25 that we've seen over the last couple of years.
Yeah, it's an interesting. We could almost have a whole session just on sort of understanding and thinking about this. What I was thinking about this today in terms of interest rate cuts, and everybody's pining and getting excited and saying there's going to be more competition. And I've got a bit of a contrarian view as to what interest rates dropping. I don't think it'll make it harder to buy. I don't think it'll increase competition, because I tend to agree with Jeremy there. But what I want to say is, if you're waiting for interest cuts to sort of save you and help you move forward, I think you're always going to be waiting, because there'll be a time, because what will happen is your life's so similar to Steve says, rather than relying on external factors, do whatever your situation dictates. So I think it's important. But I wanted to bring this up though, because everybody says this. And how do you think about, because this was, that was what, 15 years ago, or whenever it was investing. That's not taking into account the higher mortgage amount. Everybody says that because everybody says, 19% interest rates, but mortgages were sort of 50 to 100,000, whatever they were back sort of 25 years ago. How do you think about that, Jeremy, and even Steve as well?
Yeah, well, look, I'm very lucky because I get to see a lot of the ATO data every year about people's employment income. I can say people's wages, I know we're seeing a different narrative in the media, but over the last 12 years, people's wages have more than doubled. And in fact, not because they've just more than doubled in the last 12 years, business income has been quite successful in the last 12 years. Most businesses on average are now turning over more than 200% more than what they were 12 years ago, same business like for like. And we've got more people in a household working, whereas before we didn't have that. Normally there'd be one breadwinner in the family going back over 30 years ago. So dynamics have changed. Yes, household mortgages have increased. Yes, rates as a comparison compared to where they were like for like with the same mortgage 20 years ago, the repayments are higher. But what the narrative doesn't tell you is that the income of the household has substantially increased. So it's not going to get any better, because the last time I checked, and very openly anybody's out there is listening, tradies aren't going to accept any less from what they were today, say 3 years ago. So don't think that a tradie is going to do the same work they're doing 3 years ago for half the price of today. Those prices now are sticky, and that is now the new norm. So this is what people have to get used to, acclimatized to. Like when petrol hit $1 a litre, I was driving at that time, and it was the biggest, it was the biggest catastrophe that ever happened when petrol hit three digits on the board. But people got used to it. People got used to it, and now people think $1 a litre, if it ever comes down to $1 a litre, is dirt cheap, and they'll probably fill up barrels and barrels. So it's just people getting acclimatized and accustomed to seeing these numbers every day, and it will be just history in a couple of years' time.
Yeah, it's quite funny. I was doing a strategy call with a client before this, and they said, no point buying property at the moment. It's unaffordable around Australia. And then I facetiously responded with, well, who's buying them then? And I could see the cogs turn over in the head of like, wait, someone's buying them. It's definitely affordable then.
Exactly right.
The rich. And no, I think it's, we had that great session with Aaron Chrissy David last week, and he sort of, I think that, and you guys all think very similarly. It's about sort of figuring out, well, how are you gonna make it happen? If you just got to figure out a way, or how bad you sort of want something. So I want to get into, let's start sharing the numbers. Who wants to see some deals and some actual information? And even I think Steve's got some great insights here as well. But what are we sort of presenting first, Jeremy? What's happening here?
Okay, well, I'm going to present a bit of a page just to open up everyone's eyes regarding yield. A lot of people, even colleagues, clients of mine, we all talk about gross yield, but it's really understanding what those numbers present. So we did try this in the background before, and I'm going to have another crack at it. So if you can kindly let me know when it comes up.
Should work easily. Before we get into these, because let's hide these numbers. Sorry, I want to know, because I wanted to pre-frame, because I promised you to give people the insights as how to outperform, and I want to throw this to Steve first, because I know he's been investing. And he's got the impressive bit. What sort of things do you look at? I know you've spoken this a couple of weeks ago, but for those who weren't watching, what do you sort of look at to outperform the sort of property market in general, Polizzi?
So Jeremy actually hates me for this. I actually don't try to outperform the market. I really like buying robust investments. I want to perform with the market. I actually don't care if I don't beat it. Even if you perform with the market, you can still be incredibly wealthy. And Jeremy and I chat almost every week now, and he's like, Steve, what are you doing? You got to do this value add and this and this. I've been working from 20 countries the last 3 years. I don't have the headspace to actually be able to do it. But buying a shopping center like I presented a few weeks ago, where it gives me a guaranteed income, that's what I want. There was nothing special about that deal. It wasn't like below market value, huge value adds. It's just somewhere where it's always going to move with CPI and give me an income and keep me in the market and still wealthy as well. But Jeremy's going to go into how if you want to beat the market and accelerate your portfolio, which I'd actually say is probably less important for people like us, but really important for people trying to grow their portfolio quickly to get to a figure that they normally wouldn't achieve.
Absolutely.
I got a bit of a framework as well, just quickly, and no, I don't want to throw Jeremy, because he's the big brain mostly, and Steve's the medium brain, and I'm the developing brain. But no, I was thinking about today, because I was like, how do we actually think about outperforming? And for me, it was like, okay, I look at the data, and then I want to look at the deals. And then I want to I do data, boots on ground, and then deal. Because to me, if the data looks great, and data is flawed, et cetera, all reasons why median's not perfect, all those good reasons, but it's an indication at least. It points me somewhat in the right direction. And if I get the boots on the ground, like I know Joe doesn't like Armadale, but I would have bought Armadale. Not in hindsight, because I've grew up. I mean, I don't know why Joe anyway. And then sort of specifically looking at the deal, because I can, if you can sort of form that relationship with the agent and act quickly. So, Polizzi, I love your mindset, man. You're just simple, not simple, but you think you've done all the hard yards, so you just don't need to overthink it. Whereas,
Jeremy's seen my journey personally. Like my first 4 properties, I was sanding walls and replacing carpet myself to save the $1,000, $2,000, and now it's all about like assessing time versus reward. And I don't enjoy doing the value adds as much as others. So I'm really not a lover of property. I like property as a vehicle, but I'm not batshit crazy like Jeremy with it.
And what do you think? I agree. I mean, it's a good mindset to have. Otherwise, you overthink about it and you don't buy something for 12, 18 months, you miss out on gains. How do you kind of assess? What metrics are you kind of looking at, Jez, in your investment?
Look, I'm not probably as focused heavily with my heads in the book around data. I'm focusing on areas that I know, focusing on areas that other people know. So very much a populist opinion. So I think that's quite important. I don't try to uncover hidden gems in the middle of whoop whoop. What whoop whoop is for anybody out there, it is the middle of nowhere. So I'm really focusing on just popular suburbs where people have an ideal lifestyle that they want to live in those suburbs, and that's why the Gold Coast has done so well over the last 3-4 years. But if you look at the Gold Coast, the 10 years prior to that, it was probably one of the flattest markets. If anything, it was down as a percentage return, not just on growth but also on rent. So where that's done really well is it's followed that popular formula. What I will say, and it's going to be very controversial, and Steve, I do apologize because it does impact a little bit of what you do, but what I've seen is that this very much self-fulfilling prophecy across many investors who are guided by buyers agents and or property forums like the Oz Property Group. Now, if you guys can really hone and understand where people are moving, you can follow quite early that populist movement, get in and get out, and sometimes make $100,000. A lot of areas in WA, a lot of areas in South Australia, even a lot of areas in Queensland, because I manage so many different buyers agents, I would say nearly 80% of Australia's buyers agents were buying in these condensed areas and creating a significant level of demand. And then all of a sudden, so many other people who weren't using buyers agents were actually getting in a lot later than the buyers agents. And these buyers agents were getting a substantial amount of value for their clients. I actually saw some clients sell during that period of time where things were increasing, and some clients selling at good profits, making 200 grand in 2 years, and then moving that into the next popular suburb. I got one client who's done this the last 5 years, just literally with a buyer's agent, tried to buy in these areas, followed it around and bought and sold in a couple of years' time. And he was making hundreds of thousands of dollars. And in fact, a couple of those purchases and sales that he's done, he's actually sold for a lot more than what the property's value is today, say a year on. So if you can follow that, that's a really good way to hunt some profit and move your money around and try to get some decent value. And that's where, utilizing sometimes professionals early can be fantastic, because they create a market, they create a hype for a lot of other people to come into who aren't following the data, they're just following the populist theory.
Wow. So how do we actually, for those people who don't have access to all the buyers agents, where they're buying, whether that be a broker or accountant, how does the average person sort of understand that? Or is it the Oz Property Investment Index? Like, do we need to create the poll every week and sort of think, okay, now there's 48% in Perth, and last week it was 52. Looks like Perth's about to capitulate next week. We need to. Is it a mixture of that sort of sense?
It is actually, believe it or not, it's as simple as that. If enough people have a theory about something and enough people follow that theory, then all of a sudden that theory doesn't become theory, it becomes an action.
I'm declining all the Victorian posts over the next 3 to 6 to 9 months. I don't want to hear about it. Not yet.
And Victoria, I'm sorry to cut in, Steve, but I'll say it now. I'm probably, the last 12 months, I saw maybe 80% of my clients who were buying in WA. I'm now seeing probably 40% of clients at the moment presenting, and I'm running through numbers with them just to get the gearing right and whose name goes on the contract. They're buying in Victoria. This is residential space.
That's
so it's starting to, there's hype starting to go there. And again, it's that populist theory, and it will be self-fulfilling. I can guarantee you. I saw it with WA. I've seen it with Queensland, and it will happen in Victoria, especially as more and more people see value there now.
I'm thinking, Jeff, we can do something like GameStop did on the New York Stock Exchange. We'll just get everyone in Ozprop to all buy in one vicinity, and let's just really push the prices up.
Yeah, that's an interesting, the Wall Street bet's kind of interesting on Reddit. What I was going to say about that, because it's interesting that you're saying that, because it's starting to see the sentiment shift a little bit at least. And we started to see that even with WA. And even you sort of the data lags, the median price doesn't sort of catch up, and the median days on market, all that sort of stuff takes 3 to 6 to 9 months. So by the time you're starting to see that, it's not necessarily too late, but people were getting in sort of 3 to 6 to 9 months ago, so they're starting it now. Interesting. So
Mm.
there we go. Not saying buy Victoria, just hold off a little bit, please, people. Okay, no, but interesting. Okay, so let's look at these numbers. We've got this spreadsheet with teaser. How do we outperform? What are we looking at here?
All right. So what I wanted to share with everybody is it's always the flavor of the week to tell your friends about, hey, this is my gross yield. This is what how my property is performing. So I actually thought I would bring out some client data of areas that my clients have invested in roughly at the same time. And I've really tried to pick out roughly the same prices. And what I wanted to share with everybody is that it's not necessarily looking purely just at what the gross yield is versus the purchase price, but you've got to understand the dynamics of the costs attached to the property. So again, I won't pump the Victorian trumpet, but a lot of people aren't investing in Victoria because they're hearing a lot of media hype around land tax. Don't invest there. They're not pro investment as a state government. They're smashing us with land tax. And yes, the land tax threshold is the lowest in the country from a state by state basis, but I wanted to share with you how sometimes land tax is a substitute for expenses. And I thought I'd share with you a couple of properties. So North Brisbane, we're talking around the Petrie Basin. North Queensland, we're talking about that Mackay, Townsville. South coast of New South Wales, which is just south of Wollongong. South Victoria, I'm referring to that Geelong region. East Perth is around that Forestfield area, and South Adelaide, and Jeff and I had a debate of this, but it's around, I call it Moffat Vale. Most people call it Morphett Vale. But I just wanted to share with you guys that relatively they're all the same purchase prices, and their gross yields are based upon the level of rent they're receiving based upon the purchase price only, without taking into account stamp duty and incidentals. So you can see here that the gross yields are 5.5, 6, 5, 4.78 for Victoria being the lowest, as we know. East Perth at 5.8 being almost the highest, and South Adelaide being in the middle of the bunch. When we look at our net yields, though, our net yields is calculated by looking at all the costs. Now, I have not included interest on loans in this particular net yield position because it's assuming we're comparing them like for like, and we're assuming that we've paid off the home. So you can see here the expenses and total payments start to add up, and you can see here North Queensland, which has $16,000 of just holding costs out of a $30,000 income, so it's the highest. And we can see South Victoria being 8,400, relatively one of the lower ones, with Adelaide being the lowest out of all of them. We go up to look at our yields, net yields. North Brisbane has a 3.13% net yield, and you've got now North Queensland having a net yield of 2.69%. So this is the data I'm collecting, and this is what's helped shaping what areas I'm investing in, not just following the yields. What's the reason why there's a reduction of 3.31% in the yield? You've got substantially higher insurances, substantially higher council rates. Property agent fees are quite high as well, and I've left repairs and maintenance at a flat $2,500 for each property.
I'm a bit concerned about that insurance. And for those listening to the podcast, jump on the YouTube because the numbers are more. It's easier to look at the numbers, but that insurance of $4,700 is that. I mean that sounds almost like in a flood sort of situation. I hope they did those checks.
We do. We've got to remember when you're investing in these northern parts of tropical Queensland, you get cyclones, you get significantly damaging winds, but you also get a significant diminishing value of the actual property itself because it goes through different climatic changes throughout the year with 100% humidities and 40-degree weather days and torrential rain. You'll see that insurance companies actually factor that into their price. And typically speaking, the northern parts of Queensland have had a significantly higher insurance compared to many other states and many other locations and regions in the country. So you've also got to factor that in. When you're looking at these properties, they might have some really strong gross yields, but you've got to factor in sometimes why is the yield so strong? It could be you could have found a great property, but it could be because there's significantly higher costs attached to it. And that's what the market demands in terms of rent. Why? Because the costs are so high to maintain it. So this is how I review certain areas, and I'm looking at a cash flow point of view, and I'll get to the capital point of view later on in the Excel, but it's a bit of a myth buster out there, not necessarily meaning a very low gross yield means a very low net yield. You can see, as I mentioned, with South Adelaide and South Victoria and also South Coast of New South Wales, lower of the gross yields, but they're actually higher of the net yields.
That's
So
crazy,
that's
isn't it?
important for people to understand. Higher of the net yields, but lower on the gross yield side. So in the end, it's what the net yield presents us. And Steve, I know you mentioned this quite a bit with commercial property investing. In the end, net yield is money in our pocket. That's what really matters at the end of the day when we're renting our properties for long-term retirement plans and the collection of that cash flow.
So all I'm hearing is buy commercial instead. Got it, Jeremy? Thanks.
But yeah, so that's just a fact of it.
What about the deposit though, Steve? We need the deposit. And what about the risk? What if it goes vacant for 18 months? There's no growth.
Yeah. We'll talk about the capital growth play, and I think this is important. This will now start to open up some eyes, and I actually bring one of these properties that you can see on this sheet into the capital growth Excel. I wanted to share with everyone just a granny flat deal that I have. Very open numbers. I just wanted to share with people what it looked like. Now, my business plan for this particular property, and this is actually one that I probably haven't got right, and I want to share with people why I haven't got right. I bought this property during the ultra low interest rate environment during COVID. I paid $545 for the overall purchase. Yield was getting 4.91%. Now, don't look too much at the net yield because it does include the interest on loan, but this property was fully funded with debt. Not a dollar of my own money went in there. I borrowed the equity for the deposit. I borrowed the 80% from the bank, and I also borrowed 100% for the granny flat purchase and granny flat build as well. But I bought this property with the vision and the business plan that it was going to be cash flow positive. And believe it or not, during the interest rate environments where things were 2.2%, this was providing me a substantial amount of cash flow to the tune of over $400 a week. As my loans were on variable rates and interest rates tripled for me from 2.2% to 6.8%, my real numbers of this particular property now are negatively geared by $11,500. That's after taking into account a $23,800 negative geared position of the main house and a $12,000 positive geared position of the granny flat. Now, if I didn't have that granny flat, I would be in a true net loss of about 24 grand. So I am thankful that I did the granny flat because that helped reduce my net loss from 24 grand to only 11 and a half. But nevertheless, you can see how my original intention for this property was to be profitable, to be a significant cash flow earner, under 100% borrowing. And within the space of 2 years of interest rates growing, this particular property has gone from putting over $400 a week in my pocket, I should say, to now, unfortunately, costing me over $200 a week. So it's been a $600 change. For many people that are out there, if you're holding properties and a couple of them where there's a 23, 24 grand loss, and for many people out there, Jeff and Steve, they're borrowing 100% for properties, which includes the deposit, which is borrowed from equity, and the remaining balance of the loan. If you're holding 2 or 3 of these properties costing you, say, in excess of $60,000 a year, that could be a very damaging position and a damaging time within your portfolio. Sometimes that can set you back, force you to sell properties, or significantly reduce your buffer, where you start to look at property investment as a negative as opposed to a positive. So it's important you're really reviewing your numbers and looking at what you can do to improve it. Or if you had an original business strategy that was out there, it may be time to pivot.
Apart from looking at commercial property, which I think was going to be Steve's comment, which we like commercial, but how can somebody sustain that type of investment if you don't have the granny flat in these? Is it essentially?
I'll cut in, Jeff, because I wanted to ask Jeremy. I get asked all the time from people, when's the right time to do granny flats? I'm interested to hear Jeremy's perspective of when do you do a granny flat versus when do you not? When do you use leverage? When do you use cash? And just a general opinion of granny flats.
Yeah, I'm a big fan of doing a granny flat straight away. You do not wait to do a granny flat, and I'll tell you why. In 2009, 2010, 2011, clients of mine were building granny flats between $70,000 and $90,000. Today, those granny flats are renting for $450 a week. In 2024, you'd be struggling to build a granny flat for less than about $170,000, $180,000. That's the going rate of a granny flat today. And the rent on that granny flat today would be $450 a week, maybe $480 a week. So you can see that through inflation, the cost of a granny flat, the materials probably become more efficient. It's the same construction or way of building them, I don't think it's changed too much. Maybe some basics have changed and some bow ratings have changed depending on different reports. But if a person built a granny flat back in 2009, if they had that property as opposed to waiting to 2024, it's cost them double to build the same asset.
Yeah.
So for me, don't let inflation sometimes ruin your deal because it becomes too expensive to build on or too expensive to build the granny flat. If that's part of your business plan, you do it straight away because it's only going to cost you more and the rent's really not going to change, because a 10-year-old home and a brand new home, Steve and Jeff, relatively rents close to being the same price per week.
My usual Oh, sorry. I was going to say my usual conundrum with it is like you know, Jeremy, I've got a couple of properties, like one in Eagleby in the Logan Council, which is prime for a granny flat. Is do you dedicate that money to get the granny flat, to get the $500 a week, or do you put the $200,000 into another asset and buy a $600,000 warehouse that has twice the income? And that's the usual conundrum I think people struggle with.
Yeah, if you've got the equity or maybe potentially a little bit of capital that you can inject towards it, that additional income is going to help with your borrowing capacity anyways. So that may be the prelude for you to still do that additional property purchase. So not necessarily in most cases will a granny flat absolutely break the back of your borrowing. Some cases it actually will improve your borrowing position, especially on a debt to income ratio perspective. So I'm just purely looking at cost and saying, I wait 10 years, the chances are it's going to double in price to build it, and I'm just throwing away money where I could have had a substantial amount of cash flow during that period of time and a payback period of 5 or 6 years for the granny flat, as opposed to now being 10 plus years.
What I really liked was it risk mitigated, because like you said, like instead of being 20 grand negative or whatever it was, you've actually had that buffer. And then you also had the 3 or 4 years of being cash flow positive for it. So that's added another layer of protection.
Correct. So that extra, 20 grand I was getting during that period of time, I saved and it's helped hold this particular property. So within 2 years of that 20 grand per year, I've now got 4 years worth of holding money that's there. So I can hold this during the longer period of time to see hopefully interest rates come back down. But
that's an appreciation as well. I mean, not that we do it for tax, but yeah.
There is some depreciation benefit there. There is some benefit that's there, but this is just an example of, yes, the positive is that it's helping me hold this particular property during the harder period of times. But from a business plan point of view, it's not doing what I expected it to do.
What did you expect it to do?
I did believe our former Reserve Bank governor, Philip Lowe, when he said interest rates would probably be on hold until 2024.
I didn't believe him. I was like, I can't believe he just said that. What is he thinking? Why is he the interest rate god? No, he's not.
It was a very bold comment to make, and I felt that you don't make those comments without some form of gravity behind it. So I did anticipate rates to be lower for a little bit longer. Definitely nowhere near where they are today, even though I still believe they're quite low. So for me, I thought there was going to be substantially more amount of passive income that I'll generate from this particular property. It hasn't turned. So this is a property that I'm actually looking at very closely, because if it's not going to present me positive cash flow, which is what my business plan was for this particular purchase, I need to keep a close eye on it, whether I keep it long term or I flick it, get my money back and put it into a better performing asset.
I wasn't going to ask it this early in the piece because it's kind of probably the back end of our presentation. But given that a lot of people say never sell a property because you send it on to the generational wealth and all that sort of good thing, which is fantastic. But I know that you're a big proponent, or you're a proponent of considering selling. So why do you sort of look at selling properties, and when do you look at selling them?
For me, I've always got an opportunity. If there's a better opportunity, and look, regardless of what people might say, and even I've been guilty of going on many podcasts and talking about ways to grow the borrowing capacity or have, almost an endless amount of borrowing capacity. There will be a time where you do tap out. So there needs to be an enrichment, a pivot, a rebalance, a bit of a cleanup of your portfolio where you are buying better quality properties. You're buying properties that meet the needs of what you have now. You're buying properties that might be have better opportunity from a development perspective, better opportunity from a cash flow perspective, or might be an investment which you don't have to spend much time on because it could be an old one you're getting rid of. So for me, if I've seen a property substantially grow in value where the net yield on valuation, net yield meaning what's it going to give me when it's fully paid off, versus the valuation of the property now. And again, I always go back to an example, a property in southeast region of Queensland. I bought it for low 2s. I sold it for high 6s, and the rent at the stage was about $400 a week. For me, I didn't see that particular property, going to go rent of $700-800 a week, like when I bought it for 200,000-ish. So I used that money, and I then went and bought a $1 million property with no further capital other than the $50,000 I initially injected into that $200,000 property. So I got my 50 grand back, Jeff and Steve. I got this fictitious amount of profit that someone paid me after tax, which is great. And then I moved that money into a $1 million property, renting for $1,400 a week. So I turned 50 grand buying a $200,000 property, renting for $400 a week, into a $1 million property now renting for $1,400 a week. I increased my denominator, which is the asset portfolio that I had, and I increased the amount of net rental income or gross rental income that I was earning each week. That to me is a progression in the portfolio, which allowed me to have a bigger base where smaller percentage returns actually result in higher gross level of profit and higher gross level of value.
Yeah, I was going to say, Jeff, what I'm taking from that is because he's not cashing out per se. He's not selling a property and then leaving it in a bank account being like, sweet, done. I'm just going to disperse that as a profit over the next 10 years. It's transferring. So it's not necessarily a cash out. It's just a transferring. Yes, he'll lose a little bit on stamp duties and things like that. But like you said, $1,500, that eats up that very quickly.
Absolutely.
What about the capital gains tax though, Jeremy? I hear people screaming at their screens or whatever what they're looking at there. What about that?
Yeah. Capital gain tax is it's a measure of profit. I tell people that all the time. Tax is a good measure of profit. More tax you're paying, obviously in the right structures, of course, where you're minimizing things as much as you can, the more profit you've made. It's not going to run away. If anything, there could be changes. I don't think we're going to get substantial tax cuts in the future. There could be some increases to come, who knows. But for me, it's a measure of profit. More I'm paying, obviously minimizing along the way, the more money I'm making. It is a fact of life. It's not going to run away anytime soon. And it's a cost of doing business. If you ask Meriton, Mr. Harry Triggerboff, how much tax he pays a substantial amount of tax, but he knows to pay it, it means he made a profit and then can move it on, continue to make more profit and more tax that he needs to pay. But that's just the cycle of business and wealth. Not unless you've got some really great tactics to go overseas and do all those funky things. But nevertheless, for the majority of Australians, people like myself and Jeff and Steve, tax is a measure of profit, a measure of success. And it's what you do then with that level of capital after tax and how you progress it into more deals, making more profit.
Like that. Let's. I want to know your thoughts on this as well, Steve, because I reckon even though you sort of you're a bit blasé or you're a bit sort of nonchalant about I think you've actually got some really solid fundamentals yourself. What do you think about your property business plan? When you're assessing, I imagine you've got like about 500 of them, don't you, Steve?
All right. So what constitute fundamentals of a property business plan? It's just outcome. So like I've mentioned this on other podcasts, it's what you're trying to achieve over what time frame versus what you've got to work with finance. And then you tie all that up with your risk profile and you go from there. And most people pluck a number. They say, I want 50 grand, 100 grand, 150, 200 grand, or it's a wealth size, portfolio size of 5 mil, 10 mil, 15 mil. There's always that number. I kind of strip it back from that. And it's going to sound airy fairy. And I look at what makes me happy and then what do I need to make myself happy? And that's then Jeremy actually says this to me all the time. He's like, the thing I like about you, Steve, is you don't buy fancy things. You buy experiences. That's where you blow all your money.
That's true.
How do you feel about somebody saying about their investing that they do what makes them happy? How do you feel about that? Does that make you a bit uncomfortable, Jeremy?
No. Look, you've got to have a balance on both sides. Unfortunately, again, in my position as being an accountant, I do see, the nasty things that happen in life, such as, death and divorce and stuff like that. And, if you've got regrets because you've sacrificed so much and you haven't enjoyed yourself partway through it, it's not going to be fun and enjoyable. I love being an accountant. I love being a property investor because I enjoy it. And the day that I don't enjoy it and it's not fun for me anymore, I won't do it. I've seen so many relationships break down and in divorce because you've got one person who's just infatuated with building wealth and will force the other person to follow that path, and then all of a sudden what you've created together crumbles, and solicitors take the lion's share, and you're not working together anymore to build a healthy portfolio. So I agree with what Steve says. You've got to have that really good balance, and yeah, he went and did that by buying a shopping center on the weekend, like it was just something you pluck off the shelf. So no, that was those are the things you need to do. The balance is important.
Yeah, I think this is good old Ricky, the meme king, has jumped on and he said, "Who are these people with CGT phobia?" He's created a new word. I'd rather pay 100K tax than pay 20K tax. So, yeah, there we go. He's sort of advocating for potentially selling, not saying he should or shouldn't sell. But let's get back to the numbers, because we can talk about what we got next.
This is just a little bit. I like to do this with my own portfolio. So I've picked this particular client's property, which is in the North Brisbane area in the Petrie Basin, and they bought this particular property for $507,000. Overall, it did, when we add interest into account, it did make a $13,796 loss. So it actually cost them money to hold this particular property. Now, I haven't complicated things by adding, what the tax benefit is as an add back, but generally nearly 14 grand was a loss. In that year, they had a valuation being done on that property. So the property val in 1 year increased to $565,000. So they made a $58,000 gain. Yes, it's on paper, but nevertheless a gain. Take the loss into account of 13,796. They made a profit of about 44 grand. That 44 grand, when you take that as an amount, a return over the purchase price itself, it actually provided the client a yield of about 8.79%. So anyone who is holding a property portfolio and you might be losing 23 grand like I was just on the Nowra main property, or you might be losing 5 grand or 10 grand, I really suggest that you get regular valuations of your property, at least on a yearly basis. It can be done through your broker, or you might be able to have a subscription to an RP data or something like that. But getting a valuation yearly, it will help you put things in perspective. I'm losing this amount of money. It's a cost of doing business, but this is now my valuation. So again, just bringing back principles that big companies take into account, and I'll use tech businesses, for example. They will burn through cash, Jeff and Steve, like you would never believe. Absolutely burn through it. Millions, if not tens of millions and $100 million a year. But what they're working for is they're working for a potential sale that may occur in the future, a $1 billion sale. So they look at the $100 million that they lost as a cost of doing business for the sale of a $1 billion potential sale of their tech business, and they've just made $900 million. It's the old Afterpay story where the boys were losing tens of millions, if not hundreds of millions of dollars, and had a cash out of $32 billion on the sale. And I think Box bought that and weren't very happy with the purchase. So do your valuations yearly. Look at your valuations, which is what the property has actually made you as far as a capital gain is concerned, not a sale, of course, less what it's cost you. If those numbers are negative year on year, well, then unfortunately going to have maybe a compounding problem. But if it's costing you a little bit of money to keep, and you are seeing the valuations quite strong as they continue to flow through the years of ownership, that hopefully will put things in perspective to think that, well, it's not for nothing. There is a golden goose or an egg there at the very end for me to take or take from a sale perspective.
Jeremy, when you're looking at obviously the net yields, do you ever consider like cash on cash from like the original money you put in versus what you're getting now? I know it doesn't work as well for negatively geared properties, but when you've got positively geared properties, do you look at cash on cash as well, or are you purely looking at net yields?
You do. Cash on cash is a really great methodology, really great calculation to work out what are you actually making based on the money that you've invested in. You can go down that rabbit hole and really start to do that for every asset that you've got. But for me, I try to look and focus on the bigger picture. I don't go too deep into it, because I think sometimes you start to look at things and it could be positive or negative, or taking you into a position that giving you a false or misrepresentation of the real numbers. I feel looking at things like this is a much better level of return, because in the end, it's what's money in your pocket. No one really cares about your cash on cash return. It's just how much money I made from buying my $500,000 property or my $600,000 property. But this is just a little bit of a metric that I use, Steve and Jeff, when I'm deep diving into my property portfolio to work out, should I keep it? And I keep this data over a number of years. And I really then start to look back at it and say, well, the growth has slowed. I'm starting to not make anywhere near the level of return that I'm generating. Is there potentially better assets I can put my money into now?
Can I ask a cheeky kind of question? I'm sure the audience is thinking this because somebody's put in a comment saying, love a good spreadsheet. This is great. How do you could probably knock this spreadsheet up yourself, but how do people get access? Can people get access to the spreadsheet, Jeremy? Have you thought about, you should.
I do have a number of different spreadsheets I provide all my clients. I probably don't have spreadsheets that are in depth like this for many people because it does require a little bit of knowledge and education on how to use them. Because again, you only get out of the type of data that you put into it. But these are things that you can easily do. I think Joe, our dear mate Joe, who's enjoying his life at the moment in Europe, he's definitely a spreadsheet king, and I'm sure he could knock something up in a heartbeat. But it's not difficult. I'm not a spreadsheet king, but these are quite basic in my terms, and it's important though. You need to be doing this. An investor buying a $500,000 property, if you had a business, you'd be spending hours on the admin, every week to look at your numbers and understand how you're performing. You got to do the same with your properties.
And this is how you outperform. If you're going to sort of sit back and think, and I see it all the time that property investing is passive and all that. If that's the mindset you're going to take into it, that's the outcome and the result you're going to get. If you want to outperform the market, you need to sort of track these numbers, track these metrics, and then sort of say, and that'll lead into a question on us, because somebody's seen a property that hasn't seen much growth in 5 to 6 years. How should they be thinking about that property? What should they be doing?
Yeah, so you got to start making some serious decisions very soon. You've got to have a chat with agents. You've got to really understand what's happening in the market, what's happening in the area, understanding what level of infrastructure or spending is going on in that area as well, Jeff. And if things are quite stale at that particular time and there are better opportunities somewhere else, sometimes you bite the bullet. I have bought properties where they have moved I've sold properties where they have moved a 10 or 20% further since selling those properties. But I look at what I put my money into in the properties that I've purchased, and they've moved by 40 or 50%. So moving your money around, again, it's just following the same methodology that very large corporate entities do. And I think that's what people forget. You look at some very large listed REITs, real estate investment listed trusts. They are constantly, and Steve, you would know this in the commercial world, they are constantly buying and selling $100 million properties to each other because they may have bought it at 40 mil. They had an expected level of net rent that they're wanting to achieve as a percentage or yield. Property's gone up to $100 million. It doesn't meet their target anymore, and they flick it on to the next person who thinks they can make $1 from it. But they'll move that profit into another property where they can replicate their same mission or their same target. So that's how I've been very active in my portfolio, and that's where I look at the numbers to then dictate and tell me what I've got to do next or what I should be looking at next.
Yeah, do you find it hard for some clients where they've bought a property, like let's say they bought one in Brisbane in 2015 and it kind of sat there for a few years? So obviously that net return there was positively geared back then. And then as interest rates rose, obviously the cash flow kind of went down. So that net yield probably would have went to zero for that point. But then there's a shift where we get the capital growth, and then you take that into account, and obviously the yield increases there. I imagine that's a really hard point to make a decision. You've had a property for 4 or 5 years. It's not done much. It's kind of gone to zero. Knowing that the growth might come, I think that's the harder decision of whether to hold or move it on to something else.
Absolutely. But if you've done your research into other potential performing areas, then sometimes it can become a no-brainer. And we talk about Brisbane, and I can share because I've been investing there for such a long time. From when I was buying there back in the early 2011 and 12, had a little bit of a jump up. There was a bit of activity. And then for probably about 8-9 years, post that period of time, Steve and Jeff, it did not move. In fact, prices came down slightly and rents halved. I was buying there when rents were high 3s and high 2s, and they literally came down by almost 40%, 50% in some cases. Real growth started to occur there during the COVID pandemic as they received a significant amount of interstate migration, and there's been some more movement of prices since. So if you've held property there for 10 years, yeah, your property's doubled. If you've held it for 3 or 4 years, your property may have doubled already as well. So sometimes, you could be throwing your now negative gearing away in hope of more growth in the next 5 years, which may never come. So it could be an opportunity to say, well, now do I put this money into another spot where there could be some better opportunity? Sometimes it's good to take the money while it's on the table, but if you're going to blow it on Ferraris and fast cars and other things like that, it may not be the best decision. But if you can pivot that into other or better performing assets, which again, the research tells you that you're making the right decision, that could be an absolute winner. And again, I've seen people do that with WA quite successfully. Jeff and Steve, they've transacted in WA and bought and sold a number of times, and some of these people have walked out with a couple $1 million after tax in the space of about 4 years. They bought quite heavily in the early 2020, 2021. Prices in some cases doubled and tripled for them, and they sold. And they've
I really feel for those people who sold in WA just in sort of 2019, 2020 after seeing so much better. Anyway, I suppose that's a nature of the property investing or investing game as well. What do we got here? We've got commercial property.
I was going to say, Jeremy, one of the funny things you mentioned about that small kick in Brisbane, like I've purchased 300, 400 residential properties there. The funny thing is, you mentioned at the start of the podcast, it was actually buyers agents that created that false market. Like the agents at the time, they just said they sold 90% of their stuff to interstate buyers agents because all the buyers agents were buying there, and that gave it that initial kick. It wasn't actually the locals.
Now, I wanted to share again, this is another property that I have. It's a commercial property, and it was a bit of a value add deal. So again, the business plan around it was I needed to find some properties with a bit more cash flow to help support the property portfolio. In this particular case, I bought a property in Burleigh Heads, gross yield about 6.5%. Now, don't look too much at the net yield because it is taking into account the interest. But nevertheless, after paying the interest on this particular property, which you can see here is about 53 grand, I was still making about $8,500 positive cash flow. What I then did do was I spent $110,000. I didn't have any assistance from the tenant. I did this out of my own back pocket, but spent 110 grand, fully borrowed, fully leveraged, to add a mezzanine floor. And I did the deal with the tenant to receive an extra $27,000 worth of net rental income. You can see there's no additional costs that I'm incurring other than the $7,000 worth of interest. So I improved my net rental position from $8,500 by another 19, and I'm now receiving $28,100 worth of cash flow. Now, I'm not too worried if this particular property does not grow a single cent in value. I do not care. For me, it was trying to obtain as much cash flow as I could to help improve my P&L position.
Why is there a reduction? Why is there a reduction from the gross to the net? Is that the property management fee?
No, that net yield is just taking into account the interest on loans. So if I take that away, you'll see there that the gross yield equals the net yield because I'm receiving, it's a lease where the tenant pays all the costs. So I receive an abatement every month, and then with that abatement, I pay the council rates, insurance, property agent fees, which I was very lucky to have property agent fees included into this lease, and as well as water. So you can see there I'm getting a 6.5% net yield on the actual purchase price of the property. And Steve, I'm probably going to shoot you in the foot on this one, but you're not going to see many commercial properties where there's a value addition of about 24% net yield, although maybe you've probably seen quite a bit of it.
What was your one? Was it 810? What was the rental increase on that one? The one in Melbourne you did, I think was.
That was actually more than that. I think that was a 1 point.
It's not a competition.
He's just referring to the percentage. But to Jeremy's point, it doesn't matter whether it increases, even if it was to 20% instead of 24.5%. You're still in a very strong position. It's only reducing the cash flow by a few grand a year.
Absolutely. So, yeah, for me, it was a bit of a no-brainer. The reason why I wanted to do that, and again, I'll just add the interest back in so people can see the commercial property deal. It's now getting $28,110. So pretty much every 4 years, it's going to generate $100,000 worth of cash flow. Yes, there's some tax I need to pay. But this is now my strategy, my pivot into producing a much better profit and loss statement for the property portfolio that I'm holding. So again, I can help hold the portfolio for the growth, but also start to make some money for me to live out my vision, my 10-year plus vision of retiring from a property portfolio.
Perfect.
There you go. Nice. And before we get into, I know a lot of people love trusts, and we're going to talk about structures and Q&A. What have you got there cooking up with your development deal? What are we looking at?
All right. So just wanted to share just a very small deal a client did in the southeast region of Queensland. Now, a lot of people think development sometimes is the way that they're going to retire, make a truckload of money. This is a potential, well, this is not a potential, this is a live deal that was executed about 1.5 years ago, where a client bought a property for $855. They had the stamp duty and incidental costs, so total in was $890. Pre-build costs was 61 grand, which included architectural fees, planning costs, council submissions, and everything else. The build was $1.22 million. The selling costs were about 75 grand, which included agent fees and a couple other things, staging. They sold the entire development deal for 2.75, so they made $500,000 as a profit. That's what they were running around telling everybody. I made 500 grand. However, there was GST that they paid, but they got back, so that was a positive, but they also had to pay GST on the margin scheme, which was about $172,000 that they had to lose as part of the cash. One thing that they did not factor into their deal was $258,000 worth of interest. They had this interest that they were paying at roughly about 6.8%. The deal took approximately 1.75 years to finish, which was the acquisition, pre-build costs, building, and then the selling. Overall, on their entire deal, they only made about $199,000 before tax. And that was a return on equity of about 7%. So you've got to factor in that when you are looking at developing property, you've got to factor in and understand how GST works when you're carrying on enterprise, because in this particular case, he didn't factor in the $50,000 that he was going to lose for GST, $172 he paid to the ATO, $123 that he got back, and he did not factor in the interest cost. He just significantly underestimated. He looked at purely the profit on the deal, did those rough numbers, and said, that's the money I'm going to make. Took a lot of risk, took a lot of time to make about a couple $100 grand. And sometimes when you look at the effort, the time, the risk, the headache, and the stress that he went through, one would probably argue that it's not worth doing a development deal with a 7% return. And Jeff, I know you've done some developing in the past, and as developers, you're always trying to aim for a minimum 15 to 18% to make it palatable. Anything below that, you really start to run the gauntlet of probably a very poor development.
Do you find, Jeremy, you actually see a lot of clients that aren't successful developers? Because I get it when I do sales calls all the time. People say, oh, I lost money on this development, but they're not the people where the smoke and mirrors on like socials have been like, look, I made, like this guy made $500,000. You're not getting the people going on there boasting around how they lost $100,000. But do you see that from a tax perspective? Are there actually quite a lot of people that don't make money on developments?
Yeah, I'd probably say 1 in 2, Steve, very openly. Yep. 1 in 2 just walk out by the skin of their teeth, or lose. Probably they're not doing big enough developments to lose everything, but definitely 1 in 2 would probably never do it again. For those half of the people that are successful in the development, I'd probably say of that half of those, so 25%, were successful because they found the right type of property and they built the right product for the market. The other half that make profit in the development, I call it the developer's margin. That little bit of dust that gets sprinkled over your development, not because you produced a great product for the market to sell, but because everything just went up substantially. And you didn't really make money on the build. You more so made money on the capital appreciation of the land. So it's a very small amount of investors that transition into development do it right. And it's purely due to lack of education. The ones that do it well, half of them get that dust called the developer's margin, the capital appreciation of the land. And the other half of those successful developers have done it, as I said, because of some really good budgeting, really good feasibilities, and providing the right product for the market.
Yeah. So I think the point is it's not as easy as everyone makes out. Everyone just thinks, oh yeah, build a duplex, make 20% margin. Like 50% of people don't.
No,
Yeah, it's definitely hard. I would sort of say that 90% of development sites probably don't necessarily stack, and even 5% of that 10% that might stack, they're just sort of the marginal ones anyway as well. I haven't created those. As I say, 90% of statistics are made up. So, but I would imagine that if you chucked a good number of deals through, that's what it would look like. That's been an absolute masterclass in terms of numbers. I want to sort of shift gears a little bit and talk to structures and make this a lot more. I mean, it's been interactive. Comments have been flying in thick and fast on Facebook. Drop us some comments on YouTube as well. Make it easy for me to do this. Otherwise, I have to manually paste it in the thing. But before we do that, I want to make sure we jump in and play ads. So stay tuned, people, and we're going to talk about structures and who doesn't love structures and trust. So we'll run to this and then we'll get on that train. See you soon, team.
Hi all, I've got a big problem. This is the Policey Property weekly sponsorship ad. Except today, I've got nothing to sell. And this is because of you. Due to all your kind words, comments, amazing feedback, and sincere compliments about my newly released commercial property investment course, the Commercial Property Institute, I realised today that due to the Facebook algorithm, many of you, in fact, the majority of you, still may not have heard about this yet. So I'm going to do 3 things that no other course provider would even dare to do. Let's start with number 1. I've taken out 5 lessons of the course and put them in the link that's being dropped into the chat right now. This way you can see the value in the course, and you can see the production, and you can see for yourself the depth of the insight that we dive into. Every other course provider hides everything behind a paywall, and you only find out if it's valuable or not when it's too late. Not me, you're going to see 5 sneak peek lessons from the course from which you can make an informed decision about whether this is for you or not. Now, number 2. To further prove to you that this course will transform you from being a total beginner into an elite commercial property investor, I'm going to show you a picture of me before I discovered commercial property investing. And now, after I've discovered commercial property investing. Alright, you finally got your Steve without a beard shot, so it's time to get serious. Let's talk about number 3. And this will leave you without any doubts. Everything I know about commercial property is in this course. Every tool that we use at Policey Property is in the course, and it's delivered in a learn at your own pace online course at $4,997. But you're not going to pay that. In fact, you're not going to pay a cent if you're quick. I've decided to extend the free offer to OzProp Investors Group until the end of June. That's right, no cost, no credit card, lifetime access until the end of June. All you have to do is click the second link here in the chat and it'll take you to the page where people normally pay $4,997 for it. At this page, type in the discount code OZPROP and instantly get the Commercial Property Institute course for free. No catches, no gimmicks, just a limited time only offer. So click the link right now and get your instant access free. Thanks again for the amazing feedback, and I look forward to seeing thousands of commercial property moguls in the near future. Cheers, guys.
It was a bit sneaky of me to run that again. He said it was to the end of June, but apparently I still checked
go nuts, guys. Use OzProp. You know what's funny, Jeff? I mentioned this last time. That's an AI version of me talking. It's not even me talking.
I think you're in trouble, Policey, because they're doing pretty well. I mean, I don't know if they can replace the way I speak, but no. So it is a great course and good fun. So Jeremy, what are you the questions that everybody asks about trusts is or structures is, how can it help me extend my borrowing capacity? But I'm going to ask a slightly different question. Something that a lot of people aren't asking: why aren't people buying? What is the reasons not to buy in trusts?
Yeah, so there's a number of pros and cons, and I always like to start with the cons because you get the nasty stuff out of the way. Your cost, number one, I like to start off with my take on it. This is my personal opinion for all investors. Your first couple of properties you want to purchase in your own name. life changes, you have children, you go overseas, you do many different things in life. And I like to say the first couple of properties we purchase, we do it individually. Keeps the cost low, keeps things simple, and it gives you a taste into property investment. Many people start investing into property at a very early age of their career as well, where their income might not be at their peak. So your borrowing capacity will naturally increase as your income increases, or you change professions, you might go into business. So you've got to take all those variables into account. But you've gone through your first couple of properties. You're now wanting to start to get really serious about your property investment journey. You've done all the expensive things in life, and now it's getting serious with your money. Trusts and companies and all the various different structures involved with purchasing assets, not just properties, but purchasing assets are a really good tool to grow, but they cost money, Jeff. They cost money. They're not cheap to establish, and they're not cheap to run. There is more compliance involved from an accounting perspective. There's more time and compliance involved from your own personal perspective. So it's definitely something you want to look through a lens and say, I need to be ready to make this investment to pay these costs. And with that, I'll obviously see a more sophisticated level of investing to come from it. So costs are one of the main reasons. Number two, complexity. They are more complex structure. There's more things involved around it. There's more understanding and knowledge you need to gain on it. You need to make sure that you got the right level of professionals around you to help you manage it. So that's very important. Complexity. Number three, there are some indirect costs associated with trusts, and it could be potentially conveyancing, it could be soliciting, could be costs if you exit the deal, and other costs such as land tax as well. So you need to factor in these indirect costs that you get through these more complex structures, more sophisticated structures, and are you prepared and are you aware and knowledgeable about them? So if you've gone through those, that various level of education, you've got a really good professional team around you and you're understanding and aware of the costs associated with it, then it is the right step then to move forward with the more complex structuring. For a lot of Steve's clients, and mutually we share many of them, they've bought their couple of foundation properties and now they're ready to enter into the world of commercial property investment. And structure just goes hand in hand with many commercial property investments for many reasons, such as GST, carrying on an enterprise, and tax minimization. So I do say to everybody, you've got to understand the cons. Trusts and structures are alike, such as companies developing. They're all things that you do as you've really built your foundations. You've got your solid roots in the ground from a property portfolio or an asset portfolio in general, and you're ready to take that next step, that next cost of doing business, that next cost of investment. So they're pretty much the cons that most people need to be aware of. Things like borrowing capacity may come into account. Not often, but may come into account depending on legislation and also the compliance of the banks. But in more times often than not, if you're using the right structure and have the right business plan attached to the portfolio you're looking to build, that's when these sophisticated structures can take you to another level. And that's where you start to look at the pros, I should say. The pros being, the ability to protect your assets, especially if you're in business, the ability to improve your tax position. If under the right structure with the right conditions, you can substantially improve the amount of take-home money after tax from your portfolio. And again, we all know, and it's very well documented now in many people's platforms and podcasts and YouTube videos, that with the right conditions under certain structures and the right banks and the right policies involved, you can have a benefit that comes from borrowing with the right conditions attached to it. So, you don't go into structure early, and I've spoken to many people who are wanting to establish structure on their property number one, and there's very rare circumstances when we as accountants would recommend it. But for the most part, I really say to people, have a taste of property investing. Get a taste of it first. Keep your costs low. Keep the overall situation quite simple, because there's stack loads of time to make your life more complex and make your investment portfolio and journey more complex as well.
Yeah, that's the sort of things on trusts that I've seen. What I wanted to touch on that, the right conditions you mentioned about borrowing capacity, because everybody talks, not everybody, a lot of people, some people say unlimited. I really balk at people who say unlimited because it scares me a little bit. I say it can potentially extend. So what conditions need to be met? I imagine needs to be supporting itself, but under what?
Absolutely.
Yeah, and
Absolutely.
what
It
does that
needs
look
to,
like though? Does that,
yeah, it needs to be supporting itself. It means that the income generated from the investment entity itself, and we'll use what many people have, trusts, the investment entity itself needs to be positively geared. It needs to be cash flow positive. It needs to be in a position where it maintains all of its cost, including the cost of the entity itself. For many people, if they're borrowing equity or using equity from another property and utilizing that as a deposit for costs and then borrowing the remaining balance from the bank, in most cases, that means that your investments are 100% geared. Now, in interest rate environments like this right now, it's very hard to find positive geared investments with 100% leverage attached to it. I won't say it's impossible, but it's very hard. So you've got to really look at the assets where there's a very clear path to being positive. And it could be through what you saw there with that Burleigh Heads commercial property, where I added a mezzanine floor and extended the rent by a further $27,000, less the interest, 21 grand, 20 grand in total. So that's a very clear path to that property being positive. And I believe the leverage on that was probably around about 90% on cost, 80% on valuation. So it is still quite leveraged up. But you can see with my Nowra granny flat property, it's not positively geared. And that's a property that was substantially positively geared when I first bought it. And interest rates have turned that into being quite negatively geared. And that property is fully leveraged at 100%. So you need to make sure that you're finding assets with a very clear path to being positive. It may not happen straight away. It may happen over time. But if you're buying your cookie cutter unit where there's very little ability to really transform the rental income that property can provide you, then you'll find under most circumstances it might be pretty tough to achieve those level of results. So you really got to have a very defined business plan, strategy with your portfolio when you are using these more complex structures. And if you're not there yet, sometimes it's not the right time for you to enter into those structures, but with the right people around you, hopefully getting the right level of support to aid and increase your portfolio as time goes on.
I think it's worth noting, I always get people to say that as well, Jeff. Oh, you got infinite borrowing capacity if you keep buying under trust. You still need the deposit. So where does that come from? You either need the cash. So saving up 20%, 30% is not easy. Then people will say, oh, I'll just utilize some equity that I have. Guess what happens with the examples Jeremy just showed? You pull out that equity, that's no longer a profit-making property. So all of a sudden that one disappears off that infinite. So it's not as easy as things. It will help you take an extra step or two, but it's not infinite. You're not just going to be able to keep buying properties infinitely.
Absolutely. Absolutely.
Because how does it work? And I know maybe this is getting a bit into the weeds, so please stop me if I'm getting too specific. But how does it work? Let's just say I have a property in my personal name, and I extract that and have that cash lying available, and how do I then sort of use that in the trust? What is that? So because that's still just whether I save that up or have that as cash, that entity is still then and then you sort of need and you have a 30% deposit to use on that property in the trust. Does that somewhat sort of help with the helping it so be at least pay for itself? Is that sort of way it can work, or
Yeah,
not
so
really?
the quickest
Business.
way to make an entity positive is to lower the leverage through hard cash. So that means putting your hard-earned efforts from your savings into a loan, paying it down. But if you're utilizing equity from a property in your name and using that as a deposit for a property in a trust, as Steve mentioned before, that equity is, while secured against your own property, it does form part, unfortunately, of the deduction that the trust has to maintain because it was used for the purpose of buying that particular property. So in that case, it wouldn't be positively geared. The chances are it'd be 100% leveraged. Where trust can work really well is for those people that have and do have the ability to save quite a bit of money in short periods of time, where they can put hard cash down as a deposit, Jeff, and they can then get that borrowing capacity back in that time, saving quite a bit of money for their next deposit. So no doubt about it, higher income earners will get to benefit from this particular structure substantially more than lower income earners or moderate income earners. But with everything, more time that goes on, you'll find that naturally and organically through inflation, rents will start to increase and potentially rates may come down. And that's when you do have a window of opportunity that may occur 3, 4, 5, or 6 years from now. because buying a property in a very linear fashion, one every year, it is achievable, but not often seen. And I always encourage people, and I use my own buying journey as an example, is that I didn't have this linear one property per year. I was buying, I was selling, I was pivoting, I was rebalancing. But during those windows of opportunity when my borrowing opened up, I went as hard as I could. And I may have bought 5 or 6 or 7 properties in that year, and then I couldn't buy anything for 2 or 3 years after. It's just when you extend it out, it looks like I've bought a property or 2 properties every year for my investing career, but it's not the case. There were windows of opportunities. I went as hard as I could during that period of time, and then consolidated and focused my time and efforts in other areas.
Jeez, that's that makes it harder then. I thought you could yeah. Anyway, well that's a yeah. So there's an interesting question here that Kushal's asked: can you add members to family at a later date, no costs apart from accounting? I think that's challenging, isn't it? Doing it that way, because it depends on what's in that trust as well.
Your deed is the binding rules of the trust. So people think a trust is an entity that sits on a platform. It doesn't. It actually sits inside a folder that you hold in your home. It's called a deed, and it's the terms and definitions of what that deed suggests, which will allow you to add. And in most cases, I know with the deeds we use, by proxy and by definition within the deeds, those members of your family are already there. They just maybe not occurred yet. So your deed will dictate and determine what the rules of the trust are. Again, the ones we use for great-great-grandchildren that you haven't got yet, they form part of the deed when they turn above the age of 18. So, there's a lot of ambiguity across many different deeds, because so many solicitors have tried to play around with things and create the newest and best thing. But the ones we use have stood the test of time and continue to do so, with minor changes subject to legislation.
Asking for a friend who's a commercial buyer's agent, if you moved countries a lot and lost your deed, is there any ramifications of that?
There's a thing called a settler inside a trust, and ideally and hopefully your accountant's kept a copy of it. But a settler can always make an application to the courts with affidavits and other things like that to re-establish the deed. But ideally, for that friend who is a commercial buyer's agent who travels around quite a bit, I think his accountant's got a copy of it, so it's all right.
I'll let him know.
Do accountants still keep paper? Because you do have to, where a trust established, you have a paper copy, don't you? And it gets
most accountants will keep a paper copy, and if they don't have it, they've got a soft copy of it that can be re-executed. So you just want to make sure you keep these things. You don't want to lose them, because it can become a quite costly exercise. But I've had clients who have lost them, and there has been some legal practitioners about to get involved to assist in creating the deed that was lost.
Yeah, there you go. Good question, Steve. I'm very, very specific and So what I want, because somebody submitted this prior, and I thought it was an interesting one. Somebody said, is it possible where somebody's stuck and they had to take a step backwards and uncovered more borrowing capacity through the trust sort of thing? So I'm sure you've probably got 10 or 15 examples of this, but where has that sort of happened? Where I think even that example with a property up in, was it maybe somewhere in Logan, where they sort of sold, and then I don't know if they use trust, but have you got any examples of that?
Absolutely. Yeah, I've had many clients that have pivoted and rebalanced. They've had properties in their own name with a substantial amount of what I call frozen equity. Frozen equity means that the property's value is quite substantial compared to the loan, but due to their circumstances, they just didn't have any more borrowing capacity. They sold, paid the tax, and they started to buy properties with hard cash as deposits, good quality properties with good path to positive, inside trusts. And essentially, they were able to substantially borrow more than what they had before, because of the capital now that they had from unlocking the frozen equity inside their property portfolio in their own name. So I can guarantee you, Jeff and Steve, I've got a huge amount of clients with a lot of frozen equity, being the value of their property compared to the loan being quite low, but they just don't have the income anymore due to changes in their life to be able to continue to borrow. So you're never stuck. You're just stationary. and you can kind of get the motor going. You just got to have the right people around you to come up with some really good ideas, all warranted or valid or legal, to get that motor moving again.
Who do you think's the most adequate person to give that advice to potentially sell that? Is that typically come from the accountant or the mortgage broker or both?
I think it's definitely a financial planner, property strategist should give that level of expertise. But, you know, the common disclaimer that everyone puts, not financial advice. I often will have discussions with clients, not to advise them of what to do, but to open up doors or open up conversations that they just never had, or they never have the ability to speak with other people like that. So it's just the conversation you have with all the professionals around you that can open up questions that you yourself didn't know to ask. And it's not me giving advice. It's not a mortgage broker saying you need to sell, but it's opening doors to things they didn't know about. And therefore they're gaining more expertise, more knowledge, more education. And with that, they can start to make some good decisions for their own.
Yeah, nice. It's a good consideration, because oftentimes people sort of they just say, oh, it's too hard, I'm going to keep the property, I'm just going to keep status quo. But if you want to keep moving forward, maybe that is an option to consider, but you need to really run the numbers and look at it from a business plan perspective, rather than just going out and doing it, because then you might be cutting off your nose to spite your face. So speak to your broker, your financial planner, and your accountant. I wanted to throw to a question here. So somebody said, do you it's an interesting one we're talking about here. Do you see people going a cash flow strategy first? Because this was one from earlier when we were sort of talking about capital growth first. I think my personal thing is it's too hard to go down that path unless you can keep. But what are you guys' thoughts? What are you sort of seeing? Unless it's buying commercial, but then because you can get capital growth from commercial law, can't you, Steve? What are your thoughts on that question, Steve?
I think what Jeremy said before was this is what happened 5 years ago. Every second resi investor was buying these cash flow properties that are no longer cash flow properties. So I think that's the wrong way to look at it. Typically, really, really high cash flow properties are higher risk as well. And I'm not arguing in between like the capital growth phase, but you are not going to go out and buy $1 million property that's 30, 40 grand a year positive without having any risks. Otherwise, every single investor would be doing it. So as Jeremy and me always say, you always grow a good base, get the roots in the ground, as he says, then go from there.
Yeah, I will probably be less. Steve was very diplomatic, which is great. I'm going to say that you need to make sure that you're looking at both sides of the financial accounts. Because if you're going down a capital growth path where you can't simply continue to afford to keep the properties because you're chasing this capital growth, this balance sheet amount of gain that you're making, you won't be able to hold your properties for the longer period of time, number one. You won't be able to dictate when you sell those properties. And I've seen people go down a very aggressive path of property investment and lose control, and the bank comes in. It happens. So I think you've got to manage both sides of the equation. Again, you've seen what I did with the portfolio. I tried to balance the portfolio with some other properties that were more cash flow orientated. Yes, I had my roots in the ground, as I mentioned before, but I still think that if you're holding 3 properties like that Nowra one, where without the granny flat, it was costing 24 grand a year, I can tell you now, for the majority of property investors that are out there, it's damaging. And they're not going to be able to sustainably hold it.
Yeah, particularly if you have a principal place of residence and you've got interest rates where you've seen that people come off a fixed rate of, let's say, 1.79 or 1.99, and the interest on that has sort of tripled, basically, the interest alone, not the repayment. And you sort of start to think, well, wow, like how am I sort of funding these heavily negative? And even heard on your show what school should have taught you. You sort of the first call with that person, they'd sort of moved onto another job, and it's like, what happens when life happens, and then you've got 3 or 4 of those 24,000 negative properties, and you still kind of, yeah, sure, you might have some savings, but how long can you sustain yourself? That's the kind of the stress testing you need to do in any portfolio, but particularly now when rates could stay where they are for, who knows, 6, 12, 18 months. Who knows what inflation looks like.
I think what Jeremy said about managing both sides of the coin. So like, even from like in my business, like there's buyers agents that push like eastern suburbs. You've got to buy these blue chip areas, which are really, really negatively geared. Then on the flip side, there's buyers agents that are like, must buy Mackay, Townsville, because it's positive cash flow. But Jeremy showed you that it's not positive cash flow. So it's getting that balance right between both of them and not going to any end of the spectrum unless it's a plan at play.
Yeah. Well, I've probably got time for one or two more questions, but this one is, it will dovetail into one of my questions I like to ask you as well, just to understand. As an accountant, do you have many people who rent their properties out for short-term accommodation, and have they ever had to pay GST? I mean, it's a service, so I can't see why you wouldn't. Why you'd need to pay GST on that, wouldn't you, Jeremy?
No, rental income that you earn from residential properties is what they call an input tax supply. So there's actually no GST from renting out your residential property on the Airbnb platform. So for anyone that's out there, you don't pay any GST on that rental income. But there is GST when you're carrying on an enterprise in a commercial property, for argument's sake. So you know, it could be a serviced apartment, for argument's sake, or a couple other things like that. So there's some very special indicators and legislation involved with doing that. But in short, do I see people rent out their properties on short-term accommodation? I saw it quite a bit during COVID, and they were making a truckload of money. And the ones that are doing it right now, especially in the coastal areas, have all gone back to long-term accommodation because they were bleeding a lot of money. So again, economy dictated, where people are now starting to hold back on that discretionary spending, especially in the Airbnb market, and hotels and other places like that have cottoned onto it, and they're starting to heavily compete with the Airbnb market in many of the tourist-dominated areas. So yeah, I'm seeing less and less people. Even I considered at one stage putting properties onto the Airbnb market. But looking at the same data now, it's probably not as profitable, nowhere near as profitable what it was in the COVID environment, because everyone was trying to travel when we got freed up and allowed to run around our beautiful country again.
You're also buying typically in areas like holiday destinations, which might actually, they're more blue chip and have a lower yield anyway. So like then you start weighing up, do I buy a better quality investment that's got a higher yield and cancel out that difference of 20 to 40%?
Correct.
There you go. Well, there's one more, I think, unless anybody, it's an interesting one, because currently own 12% positive cash flow property. That sounds like, I'd like to, this was probably asked about 20 minutes ago. So I wonder if this person is still on. I mean, that sounds an interesting location. Thoughts on negative gearing for next buy, currently own 12% positive cash flow property. I mean, it's all about that balance that you mentioned, Jeremy, but I'd be I'd stress test that 12% positive cash flow and sort of see what could change in that location, just to make sure that is that a sustainable cash flow property. But yeah, what do you?
Absolutely. Yeah, absolutely. And let's just say, for argument's sake, it is sustainable. When people say thoughts on negative gearing for next buy, I'll rephrase the words: thoughts on losing money for my next purchase. No one should think about losing money for their next purchase. We don't buy an investment because we need to lose money. We buy an investment because we believe there's an opportunity to make money, but on a different side of the investment. As I mentioned, I've spoken about the P&L and the balance sheet of a property, the income that it provides versus the capital growth that we get. So if we are going to make a decision that we think there's a substantial amount of growth or some considerable amount of growth, which as a yield perspective, when we take into account the loss we're generating, that cost of doing business, that cost of investing, if we believe there's an opportunity to bring that into a net yield position, looking at capital gain versus a loss we make, then 100%. If you've got an existing portfolio that can sustain that without you having to put your money into it, you're using your investment money to do it, I see no issues with it. But for anyone that's out there, we don't just go buy something for the basis to lose money for tax purposes. That age-old saying that negative gearing is not a strategy, it's an outcome. So very important. You as you mentioned, you stress test your portfolio, but at the same time, if you're not needing that cash flow just yet to maintain your lifestyle, having a property with more focus on some really good growth aspects could be a great opportunity for you to make hay while the sun shines and use the investment property's wealth that you've generated to do it.
I imagine it comes down to what their plan is as well. Like if they're 62 years old and they want to retire in a few years, buying a negatively geared property for growth might not fit the strategy. So buying another 12% yielding asset. So it's always going to come down to what you're trying to achieve.
Yeah, beautiful. Yeah.
Yeah, nice. Well, Steve, I wanted to, unless you've got any burning questions, I think I want to respect all your times. Have you got any questions you want to ask Jeremy that you can't about trust deeds? Or?
No, I've got a question though. I heard through the grapevine that you drive a car with a personalised number plate of accountant. Is there any truth to that?
There, I can confirm that is true, and I was unfortunately bullied into it from Steve himself. So he
Bullied into it?
absolutely bullied
Peer
into it.
pressure.
I take absolutely no responsibility for that. That's Steve's harassment over many weeks, many late text messages. But yes, I do own a car with the number plate accountant, just in case I forget my profession.
I regret nothing.
That's I really wanted to, and I'll drop this in the. This is a new initiative that I think you're fast becoming the much younger and probably maybe not necessarily a lot wealthier, but on the way to becoming as wealthy as Dave Ramsey. And not many. Dave Ramsey's got about 30, at least 30 years on Jeremy. So this is I've listened to a couple of episodes of this one, and it's a great little podcast, and just all those foundational lessons, and it's a passion project for yourself as well. So yeah, check this one out. What school should have taught you, and ask your questions as well. I mean, there's no question too hard for Jeremy. He'll think about it and answer it and have that conversation on the spot. So I think that's a good one. But Jeremy, we've come to that time of the show. I'm not going to ask you what your favorite pizza is, but how do people get more of Jeremy in their lives?
Yeah, you can definitely reach out to us on our email, or you can find us on LinkedIn, or reach out to us in our office. Give us a call on the number below, and one of our lovely staff will be able to assist you, and we'll be able to have a chat with me personally, and we can see how we can give you some assistance moving forward.
Easy. Oh, Jeff's frozen on mine.
It's a good.
Yeah, it's now, but for me, I'm back. Maybe I'm not back. I had that conversation with you probably about 10 or 11 years ago, and for me, I learned probably more. I'd been sort of going to seminars and bought a property or two at that stage, but I learned more in that half an hour conversation. I was like, wow, this guy really knows. And this was 10 years ago. So imagine the knowledge that is accumulated now. So definitely, it's a very generous offer because you are a busy person and you've got you're father of a young family as well. So, but I just wanted to give you a shout out for giving all the value to Oz Property along the way and coming on multiple times. And everybody loves when you come on. You're one of the favorite. You are second behind Michael Shah, so you are rapidly catching him. But Michael has threatened to come back on. And big shout out to Steve Polizzi over in the UK, about to compete in the Olympics, I hear. But no, good on you for coming on as well, Steve, and just given you've just jumped off a flight. And there's nothing that Steve Polizzi can't do, I don't think.
No, thanks for having me on. I really enjoyed this one.
So thanks for tuning in, everybody, and we'll catch you, as Joe says. Let's go buy property, outperform the market, everybody. Catch you next week.